So welcome to this webinar series. Today we'll be talking about investing in shares. So for those of you not so familiar with 10,000 Girl, we're a not-for-profit social enterprise that focuses on improving the financial well-being of Australian women. Our aim is to make finance social and fun, and we talk about the 6 steps to doing a bit of a money makeover. We start always with setting life goals because you need to know whatever financial decisions you make, why you're making them, what are those financial steps and decisions going to enable in your life. Then, of course, we all need to know and have control and have solid financial foundations. So that's step 2. Step 3 and 4 are about familiarizing ourselves and building our investing confidence. And so today we're going to dive in to the topic around shares. And then step 5 and 6 are about living well into the future. So understanding and actively managing your superannuation, understanding the tax implications when investing, making sure that your wills and estate planning is all in order, and ensuring that you're building a really strong personal and professional support network. So there's a lot of elements to financial well-being, but as I said, today we're going to dive into the topic, investing in shares. We're going to cover the basics, and then we're going to talk through 3 case studies. So whether you don't have any money to invest now and you're just starting out and wanting to build your knowledge, or whether you're a regular saver, be it $200 a quarter or $2,000 a month, or you've got a lump sum currently to invest in shares, we'll take you through some different approaches and ways to invest in shares. We'll also answer some of the questions that have been emailed through over the last few weeks, and also respond to some of the questions that you pop in the question box. So feel free to write any questions you like. Greg has also kindly offered to run another webinar if there is a group of people that want to go more in depth on any particular topic, because obviously an hour is not a long time. So there are some great questions having been sent through, and there's some other good questions. Please ask questions along the way, join the discussion. And yes, there's people asking, you'll be able to get a copy of the recording, so that's with the presentation, and you'll be able to review it at any time. So we'll send you that in a couple of days, along with a whole lot of helpful links that will complement this webinar. So we're not providing financial advice, and we really encourage you to seek professional, independent advice before making any major financial decisions. But we hope this webinar will equip you with great questions to ask, and some familiarity around some of the language and things to look for when starting to invest. So thanks to our generous partners who allow us to run these programs for free. So Financial Literacy Australia and Rabobank, who have been great supporters, and especially over the last 2 years, wanting to deliver programs to reach regional areas. And then, of course, we work with the Financial Planning Association, with HESTA, with the ATO, with the Insurance Council of Australia, and with Credit Savvy, all who have really great resources on their website. So please check them out. Now, a big welcome to our special guest today. Greg Hoffman is the chairman at Forager Funds Management. He's also a great friend of mine and someone who I respect dearly. And so I'll give you a little bit of a rundown, and then I'll throw it over to Greg to share some of his experience and expertise with us. So Greg actually bought his first share at age 8. He never looked back. He spent 10 years as Research Director of Intelligent Investor. Some of you may be subscribers to Intelligent Investor, providing share market advice to over 10,000 people. Today, as I said, he's chairman of Forager Funds Management, which manages over $225 million on behalf of their clients. He also writes a monthly column for Paul Clitheroe's Money magazine, and of course manages his own investment portfolio. So thank you for joining us, Greg, and I shall throw it to you to get started.
Thank you very much, Zoe, and thanks everybody for taking the time to attend this session today. It's wonderful what technology can do. I'm not sure if my voice is too loud. Maybe, Zoe, you can tell me if people put any comments in the box if my audio is coming through too loud or distorted or anything, and I'll try and adjust myself accordingly.
Somebody said perfect volume.
Sorry, somebody said?
Perfect volume.
Oh, perfect. Thank you. So today, as Zoe indicated, it's going to be a fairly high-level look at some of the basics and some of the options that are available if you're looking at shares as an investment class. And then I hope a bit of a signpost to where you might go and take some next steps in terms of educating yourself or investing in the markets. Let's start with what a share is. So at a very basic level, it's part ownership in a company. You own one share or however many shares you've bought in a particular company. You can then vote on who the directors of that company are, and those directors are then responsible for overseeing the management of the company. And the shares also entitle you to a share of any dividends that are declared by that company over time, and of course you hope for growing dividends and profits from most of the stocks we invest in. They can be bought or sold on a stock exchange. They often come to the stock exchange to raise money for expansion. So recently we saw the float of Kogan.com, which most of you might have heard of. Don't quote me, but I think the company raised about $50 million when it came to the stock market. I think 15 of that went to Russell & Kogan and his business partner, and so then 35 million less the banker's expenses would have made its way into the business to help expand that business that's growing quite quickly. So they would have been buying more inventory, perhaps more warehouse space, investing more in marketing, that kind of thing. So that's the reason that companies come to the stock exchange initially, is generally to raise money for expansion, or perhaps the founder is selling down to diversify their own financial situation, or sometimes a bit of both, as in the case with Kogan. So then once it's listed, investors are basically selling shares to each other. The money's generally not going to the company after that. You'll also hear shares referred to as stocks or equities. So that's just jargon that all basically means the same thing. If you hear those terms, you can just substitute in your head shares.
Great.
So why do we invest in shares? You've got the potential for capital growth and dividends, and both of those can have tax advantages. And historically, as an asset class, they've provided the highest investment returns compared to property, term deposits, and cash. So on the next slide, we're going to look at that in sort of a graph form. You can see, it might be a little hard to read, but basically Australian shares are that top, well, if you're looking at the right-hand side of the graph, it's that top blue line that's been the best performing asset class over that 20-year period. They're probably flatlined in the 12 months since that chart was put together, or they have flatlined, but still been the best performing asset class over time. And you can see, just as something to note, right down the bottom, the green line is inflation. So you can see that basically all of the investment classes have outperformed inflation over time, which is important, but shares have done the heavy lifting really for investors. So if over time shares give us the best returns, why don't we just invest everything in shares and be done with it? Why do we have a diversified portfolio? Why bother holding any other type of investment than shares? Well, the answer to that is that the returns are volatile from the market overall, and especially from specific shares. So the market moves up and down. You know, you'll see the nightly finance report. You'll hear whether the market's gone up and down. You may remember cases like the GFC, or even further back, the tech crash, or even you might have heard about the 1987 share market crash. So sometimes markets move a long way very quickly, and if you're investing for a short-term goal, say you want to go on a holiday in 6 months, or you want to buy a car in 12 months, the share market's really not the place to be, because you don't want to wake up tomorrow and find that your investment's down in 20% if you're saving for a short-term goal. And the third point is that past returns may not be repeated in the future. So you'll hear that a lot if you're reading financial literature, that past returns are no guarantee of future results. But it's really the case, and the chart that you can see here is of the Japanese stock market, and you can see that hit its peak in the late 1980s at about 40,000 on their index, which is the Nikkei 225, and today the index is probably about 40% of that, probably a bit more than a third of what it was back then. They've had a 25-year bear market in shares. So that hasn't been the norm around the world, but I do want to highlight that it's possible. It's a possible outcome. So there's uncertainty when we invest in the share market, that it's not a guaranteed return like we get with a term deposit in the bank.
Great. Now there's a couple of questions that have come through. I'll read them out, and then if you think it's appropriate, go for it. Otherwise, we can cover them a bit later. So someone said, I'm wondering, what are the advantages to investing in shares as opposed to investing through my super? So we might cover that in a moment. And
yes,
then someone just said, when a company, I think it follows on from the Kogan example, when a company enters the stock exchange, is it important to find out how much is going to the founder? Is this usually revealed? I've heard that investing in a company where the founder is taking lots of equity out can quickly devalue the company value, therefore the shares.
Okay, I think that's a really great question. I don't think there's any hard and fast rule, but I always look where the money's going. So I think that Kogan example is a really interesting one. I think I've got the figures right. As I said, don't quote me, but I think they raised 50 million, and I think 15 million went to Russell and Kogan and his business partner. To me, I mean, they're young guys. I think they're both in their 30s. They've built this business that's a sort of a multi-hundred-million-dollar business, but they've probably never taken a lot of cash out of it. They've probably just reinvested that cash over the years. So I don't think it's unreasonable for them to take some money off the table and diversify it. Maybe they buy themselves a house or put some away in other investments. And the bulk of the money has gone into the business to keep growing it. If all of that 50 million was going to Russell and Kogan, his business partner, I would have been much more nervous about that business. If nothing else, it shows that the founder thinks it's a good price, a price that they're willing to sell a decent chunk of their business at. So it's no guarantee that it's going to devalue the business, but it does mean that the founder's happy with that price, happy with selling at that price. So it's definitely something I look at. There's no hard and fast rule, but the more of the money being raised going into the founder's pocket, the more nervous I get generally.
Great, thank you.
No problem. Let's move on. We've got a poll here. We're going to talk about 3 case studies here, and Zoe, you're going to set up a poll. I won't be able to see the results, so you'll have to tell me. Basically,
you go.
I was just going to say, so put yourself in one of those categories. Hopefully one of them describes you. Maybe you've got no money to invest at the moment in shares, or don't think you do. We might show you that you have. The second one is you're a regular saver, say 200 and 900 a month, on the smaller side, although 900 a month's a decent amount. Maybe you're a larger saver, say more than 1,000 a month in your household, and you're looking to invest in shares. Maybe you've got a lump sum, or maybe you've got an existing portfolio. So have a click on one of those, and that'll give us an indication of where to focus more as we go through these case studies.
Great, so votes are coming in. We'll share the results in a moment.
So what we're going to do, I'll just keep talking while you're voting. There are various ways that we can get exposure to the stock market. So jumping the gun a little bit here, but basically anybody who's got money in super, that's anyone who's got a regular job where they're being paid super. Okay, so where are we? Regular savers the most. Okay.
So it looks like people are spread around, but generally nearly half of you are saving some amount each month and looking to invest in shares or have some money to invest in shares. So we hope you find this super valuable.
Yeah, great. So that gives us a good indication. So let's move on to the next slide, because that's basically what I started talking about, Zoe. Thanks. So almost everybody is exposed to the share market through their super fund. Now, whether you're paying any attention to it or not, you will still be exposed to it. Now, here we've got a little chart that I want you to think about where you are on that chart. And we're going to come back to this a couple of times throughout the presentation. So on the vertical axis, the up and down is your risk tolerance. In other words, how much sleep you would lose if you woke up to find your investments down 10, 15 or 20%. You know, if that would really unsettle you and make you nervous and impact your psychological well-being, then you've probably got a low risk tolerance. If you're the sort of person who can look at a 15, 20% loss in the short term and say, well, you know what, got 20, 30 years to ride out the ups and downs. I know that there's going to be bad years and bad times. You know, I can get on with my life knowing that. Then you're probably up towards the top on that vertical axis. On the horizontal axis, we've got your expertise or your interest in the share market. So on the left-hand side would be you've never invested, you're not really interested that much in investing in shares. On the right-hand side is you've been investing a long time and you're super interested in learning more and doing more investing. And then that's going to place you in one of those four quadrants, basically. So if you're in that upper left, so that is you don't have a lot of interest or expertise, but you're able to ride out the bumps, you feel quite comfortable about seeing your investments fall, then the better option for you is likely to be a managed share fund, either through your super only or potentially outside of super if you've got extra money to invest. Basically, that means you can have somebody else manage that portfolio for you. You know they're going to have good years and bad years, but you don't have to do any of the research yourself. Coming across to the right-hand side, you're comfortable with riding out the ups and downs again, but you are really interested or you've got a lot of expertise in running a portfolio yourself. So you've got a lot of options open to you. In that case, you can invest directly in shares through your super fund or outside your super fund, or you can look at managed share funds, growth funds, again, through your super. Coming down to the bottom right-hand quadrant, you're really interested in shares or you've got a bit of expertise, but actually you're a bit of a nervous Nelly. You don't like the idea of having setbacks in your investments. Then you really want to limit your exposure to stocks and limit the amount of share funds that are in your super fund. So we'll look at a little bit more detail of that in a second. And then finally, we've got the bottom left quadrant is you've got no interest in shares or no expertise, and you don't like the idea of bumps in your financial future. Basically, you want to minimize your exposure to the stock market through your super there. So somebody with no money to invest now is still got some thinking to do about their super fund, basically, is what this is saying. Okay, next slide is a sample of Hester, one of the sponsors of this session. Across the top, we have four of their what we call pre-mixed options. So you'll find whoever your super's with, you can probably log in and they'll give you what they call these pre-mixed options. They probably all call them something slightly different. Maybe they call them conservative at one end and growth at the other, or even aggressive. And then you might have something in the middle that's a balanced or a medium risk. In Hester's case, they call it conservative, and then they have a shares plus. So we have the various kind of pre-mixed options across the top, and then down the left-hand side, we have all of the various asset classes that they invest in. So cash, global credit, which probably means bonds or term deposits in other countries, alternative defensives, that could be anything from gold to hedge funds. Again, you'd have to look more into what that is. Property probably means commercial property, so things like shopping centres and office blocks, those kind of things. Infrastructure, things like seaports, airports, railway lines, those kind of sort of predictable assets. Then we have Australian and international shares, and then we have alternative growth. Again, that could mean any number of things. But just focusing on the Australian and international shares, and starting in that first column, there's three numbers. Oh, can we go back? Thanks, Zoe. So in the Australian shares, under that conservative pool, you can see that the three numbers are 7, 13, and 18. So that basically means the lowest amount that they can have in shares in that option is 7%, the highest is 18, and sitting at 13. When you go over another couple of columns to the Shares Plus column, which is the more growth or aggressive option, you can see the lowest they go in that option is 23% in shares. They go up to 49, and they're currently sitting at 36, as at this was September last year, those figures were taken at. So you can see that as your risk increases, Hester's premix option includes more shares, and you'll find that's the same whoever your super provider is. So now you can kind of translate that back to the four quadrants that we thought about before and where you placed yourself. So if you were in one of those top right quadrants, then you probably want to be in something like that Shares Plus. If you were down the bottom, then you probably want to be more on the conservative side, so that you're minimizing your exposure and you're matching your exposure to your risk tolerance as well. So I hope that makes sense there of how your risk tolerance fits in with your super premixed investment option. So the next slide, it just gives an example of some of the shares that are involved in that Australian shares option for Hester and the international shares option. I just want to pull out a couple of points that I think are worth noting. When you look down that left-hand list of Australian stocks, you probably recognise most, if not all, of those stocks there. But the top four holdings in the Australian shares fund for Hester are the big four banks. They are such a dominant part of our market. When you add up those percentages, it's probably 20%, and then you go down even further, there's 1.6% in Macquarie, another sort of financial institution or bank, and another 1% in Suncorp, and almost 1% in AMP. The Australian market is very, very, very heavily weighted towards these financial companies, which means that if we have a financial crisis of some sort where those companies are under pressure, it's going to have a big impact on the Australian share market. When things are going well for the banks, things are going well for the Australian share market, and vice versa. When you look down the right-hand side, that's the top 20 shares in Hester's international shares option, much more diversified. For a start, the numbers are much smaller. So instead of the top holding being 5.7% in Westpac, it's 1.2% in Taiwan Semiconductor, and the same amount in Microsoft. And then the third holding is Google, or what used to be called Google is now called Alphabet, then Samsung, Morgan. So we're actually going down to the fifth largest holding before we even get to a single bank. Then Amazon, some of those other names you might recognise, Pfizer, the big pharmaceutical company, Apple, Bank of America, Facebook. You can see that it's a much more diversified group of companies than the Australian list. And I think that that's a theme that is worth bearing in mind, that the Australian market is very, very concentrated in those big banks, whereas internationally you can get a lot more diversification in general.
Great, Greg. Okay, so yep. Important, isn't it, to just to know and have an awareness about how your super is invested.
Exactly. So that sort of covers off that first case study. Okay, maybe I don't have any regular savings or a lump sum, but I do have super, and now you've got a way of thinking about it. Think about that risk where you are on that map, and then make sure that you've got more or less invested in shares as appropriate to your risk profile. Okay, so case study 2, which is where I think most people, based on the poll, fall into. So you're a regular saver, maybe you're saving for a specific goal or reason, or you're just generally building a nest egg for the future. If you're saving for a specific goal, say a house deposit or your kid's education, then the timeline becomes crucial. If you want to buy a house in the next 2 or 3 years, then the share market is not the place for you. If you're on track to put aside the amount that you need for a house deposit just out of your regular savings, the problem with investing in the share market over a short time frame is that the share market may fall 10, 20%, and suddenly you find that you haven't been able to achieve your goal because the share market's wiped out 20% of your savings. You don't want to put yourself in that position if you're on track to achieve your goal without taking that risk. So we really want to look to a minimum 5-year investment to ride out those market's bumps, and preferably 7, I would say. And if you're a regular saver on the smaller side, then the amount that you're saving is an important consideration. So if you're saving, say, $200 a month, that's sort of $2,500 a year, it's probably not enough to think about investing directly in shares yourself. So what you need is a way of getting access to the share market using those smaller amounts of money. So the first thing that we put up here is managed funds. So these are funds that pull together a whole lot of smaller investors or individual investors, and then all of that money is combined together and invested by a professional fund manager in a portfolio. The benefit is that, let's say you can find one where you can start with, say, $200 a month, and there are some fund managers that will let you start with that sort of money, or even $100 a month. From day one, you've got instant diversification. You're buying into a portfolio that might own 50 or 100 stocks straight away. So you're getting that diversification instantly, which is great. What to consider when you're looking at these managed funds? Firstly, you need to find one that offers one of those regular savings options. Some will let you just come in with that regular savings from day one. Some will want an initial investment, say $1,000 or $2,000 or $5,000 up front, and then will allow you to make those smaller additional investments. So once you've found one that sort of at least gives you the option to do what you want to do, you then want to understand their approach and their track record. So have a look at their results, preferably over the long term, 7 to 10 years. With 7 years now, that's really only taking us just back to the global financial crisis. So 10 years really lets you see how they perform throughout that financial crisis period, which might be interesting. And you just want to understand their approach. What are they actually doing? Are they buying and selling things like crazy, or are they long-term conservative fund managers? Are they trading futures or options, or are they just buying plain old blue chip stocks? I'm going to have a little bit of a look at the marketing material, probably on their website, to get a feel for that. Also have a look at the fees. Of course, lower is better. You want to be paying the lowest fees possible, because those fees are coming straight out of your returns, and it's a really, really important point, I think, especially in a world with really low interest rates like we have today, that the returns we've seen in the past from shares, sort of in that 7 to 9% range, over 10 years might be more like 5 to 7%. So if you're paying 1 or 2% to a fund manager, that's actually a huge proportion of those returns that you might receive. So the difference between paying a fund manager 0.6% or 1.6% is really, really important. So definitely have a look at the fees when you're considering funds. If you're interested in ethical investing, you can check out the RIAA annual benchmark report. We'll say a little bit more about RIAA a bit later on in the presentation. And of course, do your research and seek advice. There are sites out there that compare funds. You can have a look at things like CanStar, and also Money Magazine that I write for, their December edition. They call it the best of the best edition, where they compare a whole bunch of financial products, including managed funds, and give them some ratings. So there are ways that you can sort of have a bit of a look and a compare.
There's some great questions coming through, but I might let you keep on a roll for a moment, and then I'll read them out, because some of them might end up grouping together. Does that sound okay?
Yep, sounds fine. So the next slide will show the difference between you might think, okay, well, I'm going to invest in an international shares fund. This shows the difference between the best and worst performing international share funds over the 5 years from 2010 to 15, and you can see that there's a huge difference. The worst performing fund, the one on the lower part of the graph, basically you lost half of your investment over that 5-year period, while the best performing fund, you were up 200%. So you turned $100 into 300, or you turned $100 into 50. So it's really important to have a look at those track records and the fees. I would bet a large amount of money that that worst performing fund was also a high fee fund. So that just shows you the difference that bit of research can make. Make sure you've got a fund manager who's got a sensible approach, who's got a fair fee structure, hopefully a cheap fee structure, and has got that track record stretching back, say, 10 years, which takes you back past that GFC period.
Great, thank you.
Now, not so many people, I think this was our smallest category from what I remember of the poll, so I won't spend too much time on this, but if you're a bigger saver, if you're putting in, say, $1,000 a month, you can consider basically everything we just talked about as per the smaller saver, but you can also consider LICs and ETFs. So they are listed investment companies and exchange-traded funds, which we'll go into a little bit more detail about in a second. And you can also consider direct shares, just picking stocks yourself. That's 12 grand a year. Probably the minimum amount I'd say anyone wants to buy in a single stock is, say, $2,000. So that would be 6 stocks a year you could buy if you were saving $1,000 a month.
So
let's go to
Greg,
yep.
Just as there are a couple of questions that are sort of interesting as we go through these next couple of slides. So someone said, an advisor has recently suggested I invest using a managed fund, but I'm interested in being able to buy direct through CommSec. What are the pros and cons of both approaches? So that's sort of what we'll cover in a moment. And then someone else said, so if you research a super and they're investing in shares, like mainly with the big 4 banks, you would therefore recommend to diversify and not invest separately into bank shares. So they're obviously drawing a conclusion about diversification.
Great. I think that's, as Tony Jones would say, we'll take that as a comment, and it's a very good one.
All right. So and then people are asking about investing inside super versus investing outside super. So I think we'll talk about that.
Yeah. Okay. Yeah. We'll talk about the inside versus outside, maybe in the question section, because that's an interesting one to get into.
More about goals and timeframes, as you've inferred earlier, isn't it?
Yep, and also just what we're doing here is just trying to give you a high-level overview of terms that you might encounter and options that you have to invest in here in terms of what you want to get invested in. The question of inside or outside super is a question of what we'd say is structure, and so we'll talk about that a bit later. We'll get these basics covered off first. So an LIC, a listed investment company, is a company that exists to own shares in other companies. So basically the idea is very similar to a managed fund. You get that instant diversification, you get a professional manager looking after your portfolio for you, so you don't have to worry about, and they can be very low cost. And they're usually simpler than a managed fund from a tax perspective as well. But the key difference with most of those managed funds is that you purchase them on the share market like any other stock. With a managed fund, basically if you want to invest in the fund, you will go to the website of the company or ring them up, and they will send you, or you can fill out online, an application form. Then everything is basically done without the stock market. You don't need an account with a stockbroker to invest in a managed fund. It can all be done just through paperwork with you and the fund manager. These listed investment companies, you need a stockbroker. You're buying shares in a company. So that's the main sort of technical difference in terms of buying that LIC versus the managed fund. and come tax time, the LICs are simpler. Basically, if you haven't sold any shares, you'll just get your dividends. They usually pay sort of 2 times a year, they'll pay dividends, and that's a really simple process. The managed funds can be more complicated at tax time. The statements they send can get pretty complex, and you'll almost certainly need an accountant to help you fit those in, whereas the LICs are quite simple.
There is a tax question that's, I think, relatively easy to answer as well. Can I throw that in?
Let's try it.
If we try to invest cash by ourselves, minus a stockbroker, and our shares grow, but we don't sell, do you pay tax on that? Capital gains, is it? Or is it only in the financial year you sell?
So the person is saying if they've bought shares, when do they pay tax if they make a gain?
Exactly,
yeah. So it's only when you sell. That's right. So if you hold your stocks for 20 years or you never sell them, you'll never pay that tax. And that basically means that, and people do this, they hold them for a long time, and that means that that money that you effectively owe to the tax department, you're getting continued use of that money, and you're still earning dividends on that money while ever you're holding that stock. So it's really one of the great things about the stock market is that you can control that taxation on your capital gains. Not so much your dividends, but certainly your capital gains. So it's in the year that you sell. Okay, so turning back to these listed investment companies, the next chart or table shows basically the 5 largest listed investment companies in Australia. Australian Foundation has been around, I think it might even have roots stretching back before the Great Depression, but anyway, it says he listed in 1936. It's a $6.4 billion fund. Argo is very similar. Milton is quite similar again, so they've got huge track records stretching back decades and decades and decades. They're large, they're very low cost, so they don't pay an outside fund manager to run their portfolios. They employ staff to run their portfolios, and what that means is their costs are very, very low, like 0.15 or 0.2% at the most of their total sort of value every year goes in costs. Whereas if you compare that to, say, WAM Capital, which is the 4th one on the list there, WAM is much more recently listed, although it's sort of more than 15 years now, and has a very good track record, but it does pay an external fund manager. I think it's more than 1% they pay to manage their portfolio on their behalf. So their costs are higher than the 3 above it, and also the one below it, BKI, which is also internally managed, is the jargon. So they employ those fund managers themselves, whereas WAM Capital is externally managed. It pays a fee to a fund manager to run it. That fund manager's done a very, very good job. I just point out that it's a higher cost, so they need to keep doing a good job in order to justify their fees. But there's sort of 5 options. You can go and have a look at those websites, and they're just a way, again, if you want to get instant diversification, but you don't want to be buying individual stocks yourself, of getting that. You set up a brokerage account, you buy one of these LICs, and they're doing the job for you, basically.
So a couple of quick questions about LICs. You're buying shares in the LIC, or they represent you and invest into stock on your behalf? Then the other question is, how do you advise finding and choosing one?
Okay, so the first question is you buy shares in the LIC, and that then gives you an interest in their portfolio that's existing. So that's all you need to do is buy those shares, and then you've basically got a small portion of the 100 or however many stocks they own. Sorry, what was the second one?
Oh, how do you find and choose one?
Yeah, well, I think the track record, if you look at the track record of AFIC, as we call it in the industry, and Argo, very, very good over the long term. How do you choose it? I don't want to get too technical here, but if you go and look on their websites, you'll find every month they release a statement that says, here is what they call it the net tangible assets of the company are. So basically, if you add up their whole portfolio of shares and then divide it by the number of shares that they themselves have outstanding, you'll get a number, say $6 per share. Sometimes you'll find that the share price that you have to pay to buy into AFIC or Argo or any of these is actually higher than that buying portfolio value. I like to buy these things when it's lower, when the share price is lower than the actual portfolio of shares I'm getting, and you do get that from time to time. Say back in the GFC, a lot of these stocks were trading at a discount to that underlying portfolio. But I mean, for the most part, focus on that long track record, have a look at that dividend yield, and I think if you stick with these big ones, you're generally going to be pretty safe. So there are a couple of other technical aspects, and if we do another webinar on them, we'll go into those maybe a bit more with a case study. I won't get bogged down with it here, but for the most part, if you stick with these big ones, you can look at that dividend yield and go and have a look around their website, make sure you're comfortable with their approach, and choose on that basis. But we may do some more work on that down the track if people are interested.
Great, thank you.
The other option to talk about, and like the LICs, you purchase these on the share market, are exchange-traded funds. So the LICs are actively managed. They have people who are actively trying to pick stocks that are going to do really well. The exchange-traded funds aren't trying to do that. They're just trying to get the same or as close to the index as they can. So every night when you hear about the All Ordinaries Index or the ASX S&P 200 index, they just want to match that return and keep their costs super, super low. And over time, that beats most fund managers. Most fund managers, by the time you pay their expenses, are struggling to just beat that market return. So a simple index is not trying to do anything fancy. It's just trying to match that return that the market's going to get, beats most fund managers. That's a dirty secret that the industry doesn't like to broadcast, but it's true. If you want to get more complicated, there's other exchange-traded funds where you can look at currencies or commodities or bonds. And on the next slide, we've got a sample of some of those. So the first one's quite a large exchange-traded fund. That's basically a fund that'll track the Japanese stock market. And you can see the expense ratio there on the right, 0.56, which is high as far as exchange-traded funds go, but low as far as most managed funds go. So that's why, in general, exchange-traded funds can be an attractive option from an expense point of view. If you went and looked at a Japan fund run by AMP or who else might run a Japan fund? I don't know, Macquarie or a Colonial, those sort of for-profit fund managers, you would find their expense ratios are probably 1.2, 1.5, maybe even 2%. So you can see this is quite a lot lower than that. The next one's a Vanguard Australian Shares Index, and you can see that's just trying to track the Australian shares index over time, not trying to do anything fancy, and the expense ratio is about as low as you'll see, 0.15%, versus, say, a perpetual Australian shares fund or a MLC Australian shares fund might be charging you 1% a year or more. This is charging you 0.15. And as I said, over time, they will beat most fund managers. It's quite a simple and powerful option. Then there's some more specialist ones here. If for some reason you were excited about the global telecom industry, you could buy an ETF based on that. There's the physical gold ETF run by ANZ if you, for some reason, you're a gold bug and think the gold price is going to go through the roof. There's also a physical renminbi, which is the actual name of the Chinese yuan, if for some reason you wanted to have exposure to the Chinese yuan. And there's dozens and dozens of these, but I think the meat of this is really, say, those index funds, that Australian shares fund. If you are looking at an option to get into Australian shares, that kind of super low cost index tracker is an interesting option to consider against a listed investment company or a managed fund or even a direct investment yourself. Okay, so that's for the bigger savers. You know, you can start looking at those options.
So there's a couple of questions. So is this another name for index fund?
Yes, exactly right.
And what do you think about artificial intelligence, AI investing e.g., where the computer decides what you invest in, which is coming out at the moment?
I guess it depends how good the computer is. I mean, yeah, I wouldn't invest my money on that basis.
Essentially, some index funds are, sort of, computer algorithms in some ways, but maybe a better bet than...
Yeah, but they're not trying to beat the index. They're not trying to do anything fancy. They're just trying to match the index. So the difference with some of these fancy artificial intelligence things is that they are trying to get a very, very high return. And my concern is sometimes they go haywire, and we've had a couple of little examples that probably haven't made it into the mainstream press, but they made it into the financial press with some of these sort of things going haywire and causing mini flash crashes where the computer just malfunctions and sells a whole bunch of shares at silly prices, and they can be very expensive. So I'm nervous about it, and I wouldn't say never do it to anyone, but it's not for me.
Okay, great. And then one more, what's the minimum, just to recap, what's the minimum generally thought of for investing in LICs and ETFs?
Sure. Okay, so again, just to reiterate that key point, with both of those listed investment companies and exchange traded funds, you have to buy them on the share market, which means you have to pay a broker some brokerage, which probably as cheap as you could get is $15 or $20. So I think the minimum you need there is probably $2,000. That means if you're paying $20 in brokerage, that's 1% of your investment that's going in brokerage. Much more than that, and it's getting a bit expensive, I think. So I'd say, as a rough rule of thumb, 2,000. But as actually just a technical point, I think the minimum amount you can buy is about $500.
Great, thank you.
Okay, so case study 3, and there are quite a few people in this option. I think it was the second most popular, is, okay, you've got a lump sum to invest. Basically, you've got all of these options that we've touched on open to you. You could construct your own portfolio of direct shares. So as I've said, $2,000 is probably the minimum you want in any one share. That would mean that you could invest in 10 different shares, which is getting to be enough to be diversified. Or you could consider LICs and ETFs. You could invest maybe $5,000 in 4 different LICs and ETFs to give yourself a bit of diversity. Or you could consider a managed fund. One managed fund, or maybe you split it into 2 or 4 funds. $5,000 in each of 4 funds. You've got a lot of choice, and we're going to again map that on that sort of risk map that we looked at towards the start here. So if you're in that top left, in other words, you're not that interested in the share market, or you don't feel confident in the share market at this stage, but you are able to ride out the bumps, then you can look at your lump sum going into one of those LICs or ETFs, or a managed fund with a growth focus. If you're moving to the right, you're able to ride out the bumps and you're really interested in the share market, or you've got a lot of expertise, then you can consider picking your own shares, or again look at the LICs or ETFs, including some of those more fancy options if you really want to pick sectors or currencies or anything like that. And you can look at managed funds as well. Maybe you're interested in picking stocks in Australia, but you don't want to pick international stocks. So let's say you put together for yourself 8 Australian stocks, and you put 2,000 into each. That would be 16,000. Then you might put, say, 4,000 with a managed fund in overseas stocks, because you don't want to do that yourself. So that's how you might use those two things together. Coming down to the bottom right, you're really interested in shares, but you're a bit nervous about losses. Then you could look at direct shares, but stick with those blue chips, the more conservative stocks that have been around a long time and are profitable. You can look at those listed investment companies, again, the conservative ones that have been around a long time, like the ones that were on that slide. You could look at ETFs and focus on ETFs that have more defensive qualities. In other words, ETFs that are put together to not go down so much. So you mightn't get the upside in bull markets, but you won't get hurt so much on the downside. And you might look at a managed fund that is not totally invested in shares. Maybe they're more of a balanced fund. And then the final quadrant is you don't have that much interest in the stock market and you don't have much risk tolerance. You basically want your lump sum to be invested in a diversified fund that doesn't have that much exposure to the stock market. So you go and find yourself a balanced fund or a conservative fund so that you're not too exposed to that.
Great.
Okay, so we're going to go into a little more detail on direct share investing, just in terms of what's involved, what's required. Now, I haven't got a watch near me. How are we going for time here?
Well, we've got 10 minutes and lots of questions, but as we might be able to go a little bit over time, and if people miss the end, they can listen to it on the recording. And also, as you say, we can run another webinar. We can take all the questions into account and run another one at another time, because I know some people are at work, so we'll try and keep as much of the time as possible.
Yeah, I want to respect people's time. So we'll move through this fairly quickly because we can't do full justice to it anyway. But if you want to start picking shares for yourself, just at a higher level perspective, you're going to need to educate yourself up front on the stock market, how it works, and on specific stocks. And then you're going to have to put time into monitoring the stocks that you buy, and also generating new ideas. So if you have a stock that gets taken over or you want to sell one, you've got to come up with a new stock idea. So you need to spend a bit of time ongoing on those kind of things, and also on record keeping as well, keeping track of the investments you've bought or sold, or the dividends that you've received. So there's quite a lot of time involved if you do want to pick your own shares. It can be great fun if you're wired the same way as someone like me who really enjoys the process. But if you're not, then they might be reasons why you prefer to go another option, like a managed fund or even an LIC or ETF. In terms of that upfront education, the topics that I think you need to think about are portfolio construction. How do you put together a properly diversified portfolio of stocks? That's a topic in itself. Stock analysis. How do you go about when you look at a stock, knowing if it's in good financial shape or bad financial shape, if its shares are cheap or expensive? You need to think about accounting. That's a really important part of that stock analysis, understanding a bit of basic accounting, and also some financial history. Where have people gone wrong in the past? Where have companies gone off the rails? Where have investors gone off the rails? The nature of panics and manias and booms and busts, all of that's important context to have. So they're all sort of broad topics that I think are worth reading about if you're going to consider investing in shares directly. Then in terms of the ongoing monitoring that I spoke about, once you've educated yourself about the upfront issues, you want to read the financial press, keep abreast of the main news points that are going on, have a look at the half and full year profit releases. So at the moment we've got a lot of companies releasing their full year profit numbers for the year to 30 June. So if you own shares in stocks or you're tracking stocks, definitely want to be getting hold of those profit releases and reading what management's saying and having a look at those numbers. The annual reports, which give you even more detail than those initial profit releases when they come out. Usually some of them are actually released now with the profit results, some get released a month later. And then in October, November, we have annual meeting season where the companies face their shareholders face to face, and you can get the transcripts of those meetings from the ASX or from your online broker if you have one. So they're important to keep abreast of as well. So if that hasn't put you off direct share investing, there's a few books here that you can consider. A great place to start is a book called One Up on Wall Street by a successful fund manager called Peter Lynch. Shows how just the average person on the street can turn what they know to their advantage in the stock market. There's a book that was written by a former colleague of mine called Value, Intelligent Investor's Guide to Finding Hidden Gems on the Share Market. You can get the book on special order, or you can just find there's a free online PDF if you Google that name. And I think it is just outstanding. I think James did a really great job. He takes you through some basic accounting, but he does it in such a fun, engaging way that I just highly recommend it. So PDFs available for free, and you'll learn something for sure. The book that really changed my life is the third one on the list, called Buffett, The Making of an American Capitalist by Roger Lowenstein, that talks about the methods and the history of Warren Buffett, who's generally acknowledged to be the greatest investor of all time. In fact, I'm sitting under a letter as I'm talking to you from Buffett for my 21st birthday. So my mother got in contact with him, and he very kindly wrote me a letter saying, "Dear Greg, your mother mentioned that you're turning 21 soon. Best wishes for a happy birthday and good luck with your investing. I hear you've done well. Warren E. Buffett." So that's a great book that's very accessible. It's more biography than investing book, but you'll learn a lot about investing and also some of that financial history as well. Then you can move on to things like the ASX newsletter and the website. There's a lot of resources on there. Go and have a look at the individual LIC and ETF websites. Again, a lot of information there. And then if the ethical dimension is an important one to you, have a look at that Responsible Investment Association of Australasia and their annual report. But that's another really thorny topic, because one person's ethical investment is not necessarily another's. So zooming out and just looking at the next steps, I think the most important thing is to know your situation. So where is your super invested? How much do you have available to invest outside super? Have you got all of those basics in place, in the context of the steps that Zoe outlined at the start? The second part is knowing yourself, really understanding your risk tolerance, because the worst thing you can do is panic and sell your share investments at the bottom of the market. And so you really need to be honest with yourself about your risk tolerance. And if you don't have much risk tolerance, that's fine. Better off to be in the right investment from the start than be in a higher risk investment and get panicked out of it at the bottom. That's a surefire way to lose money. Know how interested you are in investing and how much time you're prepared to devote to it. And that's, to put that in some jargon, are you an active or a passive investor? Are you really interested in spending hours and hours a week on this stuff? Or are you just happy to know where you are on the risk curve and be a passive investor in a fund or an LIC or an ETF? And the third is educate yourself. Focus on the areas that are relevant to your goals and interests, and know which modes of learning work for you. If you're the sort of person that learns best from books or online courses or podcasts or face-to-face courses or webinars, then focus on those modes of learning that are going to you're going to get the most out of. And that's the end of the official spiel.
So thanks again to our to our partners that enable us to run these programs, and also Greg, thank you so much for your expertise. We might run that poll now, shall we, about if you want another topic, what are you most interested in, and then we will spend the next 5 or so minutes going through some of the great questions that have been asked. So give us an indication of what you're most interested in, and then yeah, votes are coming in, and then we'll take some time to answer the questions.
That's great. Yeah, don't feel any pressure to vote for another webinar. I just put it up there as an option.
Well, it looks like we're going to keep you busy, Greg, because there's a lot of people interested in some more information. So
great. Well, that's really encouraging, because look, I think it is an area, just to sort of address this at a high level, it is an area that even if you don't have the money and it's just invested through your super, I would say most people don't know enough about. So it's actually really encouraging that people want to know more. All right, okay, so it's a good spread. There's 0%, no more webinars. This has been...
I know, exactly. You're locked in.
Good on you, everyone. Well done. All right. I'll talk...
compile all the questions, and then we can decide how we go forward.
Sorry, say that again.
Well, we'll compile all the take those results into account and all the questions that have been asked, and we'll just see sort of what areas
Okay, so for now, because that's our hour. If people have to go back to work or whatever, I'm not going to be offended. In fact, I can't even see if you've dropped out of the of the webinar or not. But I'll just take a few minutes to answer some of the questions. I guess people can come back and listen to the recording if they have to go anyway.
Yeah. So
But some of those ones.
a few people have dropped off, but we've still got like over 50 people, so it's worth
Okay,
keeping them.
let's go through a few questions. So some of those ones that we got through before on email. The first one was, I've chosen shares I'd like to invest in. How do I go about it? Do I have to go through someone to purchase, or can I do it myself? If it's up to me, what on earth do I need to do? I don't know where to start. If through someone else, what will the cost be? Is it one-off or ongoing? These are great, great questions. So the answer to that is you need a broker, but the good news is that nowadays that's not some, guy with slick back hair sitting in a fancy office in Sydney in a sharp suit. Um, it's generally for all share investors that I know, well, almost all, have just an online broker, an online platform. So you might have heard of brokers like E-Trade or CommSec or Bell Direct. They're just websites that you can sign up for, and once you've gone through the paperwork, you can then buy and sell your shares through those online platforms. In terms of the cost, you'll be charged per trade you do. They'll charge you a brokerage on a per trade result. So my wife and I were just comparing a couple of brokers yesterday. One was charging for a trade up to $10,000. One was charging, I think it was $19.95, and the second one was charging $14.95. So if you're buying less than $10,000 worth of shares, that's kind of the ballpark that you'll be paying. And then as the amounts you're buying get bigger, the brokerage falls as a percentage, not as a dollar, but it'll fall as a percentage. The other aspect, once you've got a brokerage account set up, and let's say you've even bought a share, is proper record keeping, which is, I think, an aspect that is not very, not a lot of fun to talk about, but it's very important. So the first thing you'll need to do is, and we can talk about this if we do another webinar, but the first thing you need to do is when you buy or sell, the broker will send you a contract note. What that is a summary of the trade that you've done. So it'll summarize how many shares you bought, at what price, and how much brokerage you paid. And that's really important because that forms the base of when you eventually sell the shares, how much capital gain you made. So you really need to keep hold of that and store it properly, and then that'll match off against the sale when you do sell the shares. Then what will happen is you'll get some kind of form from the share registry of the company, which is a firm that manages a lot of the admin around share ownership, and you'll get a form that says, please let us know your tax file number and your bank account for any dividends, so that if you don't provide your tax file number, they'll assume that you're an offshore investor and charge you the maximum amount of withholding tax, which you don't want. So there'll be some paperwork that arrives from the share registry when you buy a company. They might even send you a form for what's known as a dividend reinvestment plan. So if you don't need those dividends paid out to you in cash, you can just have the company, in some cases, automatically reinvest them every time. It's a great way to grow your shareholder or shareholding over time without incurring brokerage. And the other thing you'll get is a CHESS statement. Again, this is fairly technical, but in Australia we have a system called CHESS, all in capital letters, which, if my memory serves, is Clearinghouse Electronic Subregister System. So what that means is when you buy shares, they're registered in your own name. So if something happens to your broker, if your broker goes bust for some reason, there's no question who owns those shares. They're your shares. In the US, they have a different system where the broker owns the shares. Excuse me. So it's a much, much safer system, and you'll get a statement from CHESS that summarises your holdings. One final point, a drink, sorry, is if you're going to see an accountant to do your tax over the next couple of months and you're interested in getting into direct shares, ask them what sort of records they'd like to see when you come back next year. They might even help you with a spreadsheet or some system that they have to help you maintain the records. Zoe, do you want to pick another question?
Well, I think that we've covered, like we've talked about finding managed funds. We've talked about the pros and cons, like when someone said, I'm saving money for my kids, you know, is it cash versus shares? And well, maybe we talk about that because that might link in a couple of the other questions about time frames, really. And because, yeah, I mean, time and diversification are pretty key, aren't they? So that.
Okay, well, let's talk about that. You know, you're setting money aside for your kids, and I think the person said 18 plus years away. I'm assuming that means 18 plus years away from needing that money. I think what that means is that longer time frame means that shares are, you know, generally something you should consider. You know, that's the best time frame for shares. When you think back to that chart that we showed towards the start that showed how shares have performed relative to all other asset classes, the longer you go, the further out in front shares get. So, you know, 18 years is a good time frame. As the caveat to that, the asterisk is there's no guarantees. I showed you that chart of the Japanese stock market, but I would say you could be 95% sure that you'll be better off with a diversified share portfolio than just leaving it sitting in cash over the next 18 years or so.
And maybe if we have one more, if I only have 3 or 4 grand, one investment or 2 or 3, because there was a couple of questions that came through about, you know, LICs or ETFs or both. So okay. That can link in.
So this is the question is, if I only have 3,000 or 4,000 in total, am I best to stick to one investment or look at 2 or 3? And I think here it's a question of context. One is, if this is a really material amount to you, like if it's an amount that's taken you a long time to save, and you're not in a high-paying job, then you need to be more conservative than you would be if this is something that you've got 3 or 4 grand, but you're also likely to have another 3 or 4 grand in 6 months' time, and then another 3 or 4 grand in 6 months after that. If you're in that kind of situation, then you can build a portfolio over time. So you might put 3,000 potentially even into one share today. Then in 6 months' time, you buy your second share, and then in another 6 months, you buy your third share. And basically, after 3 years, you're going to have a diversified portfolio of shares. But if this is 3,000 or 4,000, and you're not in a position where you're saving every month, and this is going to be your main investment for the next 5 years, then you're better off having it somewhere diversified, like a managed fund or an LIC or an ETF. So the context is really important.
Great. I think that's probably a good point to leave on. Now, please send through. There's heaps of questions that come through, and I just don't think it's possible to look at them all. But we will definitely run another session. We will take into account those questions, because some people have even said in the next session, can we ask this? And so we'll let you know when that's sort of been organised. Thank you very much for all your participation. It's been fantastic. And thank you very much, Greg, for your time and expertise. We just hugely value it, and we look forward to the next one.
Thanks, everyone. I really enjoyed it, and thank you so much for your participation. It's been great.